The bullish base case has been completely destroyed by today's aggressive selling, and that's exactly why we're calling into session an emergency meeting. Let's talk about what happened and, more importantly, what we're looking for next. The bullish base case outlined that we wanted to see the three equal highs from way back over here, the initial tariff volatility, hold up for a potential structural change to act as a higher low. We were trying to navigate from capitulation low, everybody throwing in the towel on the failed gap down, to then a trend change on the daily time frame chart with some sort of higher low here, over the three equal highs with some respect to the overshoot of the Wednesday low from last week. So the first red flag that unfolded on this morning's session was the gap down. We opened on a gap down underneath the inside bar low. This, of course, is Thursday's range from last week, which is a red flag because we know that markets move from compression to expansion. So if this is technically range compression, then the gap down immediately offered an opportunity for range expansion, and in this case, of course, in the downward direction. The second red flag was that we were opening so close to the low of the Wednesday session from last week that there wasn't really going to be an opportunity to try to set some sort of support, testing it from the top side down. We were opening so close that any downside activity was likely to break that low in the first place. The third red flag here is the fact that on the open this morning, there was no attempt from the buyers whatsoever. Let's take this thing down to a 5-minute time frame chart here. On the intradays, there was no attempt from the buyers whatsoever. After this indecisive doji as the first 5-minute bar, the market broke the first 5-minute low and never looked back. It was not able to attempt any price acceptance inside the first 5-minute opening range. Nothing here, nothing over the high of day, no attempt to close the gap overhead by any stretch of the imagination. And we actually talked about this as the market was unfolding at the first attempt from the buyers to try to rebound off of the overnight low. I'll flash up the screenshot now. We also posted it on X, but we were making note that the tick on the intraday as this first initial bounce was taking place. I'm going to zoom in here on the ES chart. Let's go to a 5-minute chart here as well. If I zoom in, you can see the lower wick on the second 5-minute bar was a bounce off of the overnight low. Look at what was happening here in the first couple of, these are 15-minute bars on the tick now. If you look at the tick there, it was suppressed. It was down around negative 800 as the market was trying to hold the overnight low, and it wasn't really doing so very successfully, right? So a bunch of red flags here immediately out of the open that buyers were not stepping up. The second thing that took place, or not even second thing, but internally, the second thing that I was not fond of was the open way down here in trend lower zone. If this was going to be a more balanced gap down, meaning that just a handful of names were causing the pain, you could have seen an open that was here, something like negative 600, negative 750, not the case. So at the exchange level, after all of last week, if I just reset this, right, we made this comparison in the weekend video on Saturday. We made the note that we had bullish inflows here, neutrality as the market moved lower. This was Powell, so we write that off as sort of a catalyst volatility. This was inflows on the inside session from Thursday of last week. Last week really did not mark any big bearish internal exchange level data. You can see that here in the cumulative build as well, and you can see that all of the advanced decline line activity outside of Powell's conversation here was over the zero mark. So the fact that there was such an aggressive flip-flop on the gap down here this morning is really what drove markets in the downward direction, in my humble opinion here. So what do we do about this going forward? That's great. We can understand why this took place. Buyers didn't step up. We gapped down underneath the key level. I get it, right? But what do we do about it going forward becomes the next most important piece. Well, let's go back to our daily time frame chart. Obviously, the base case can no longer suggest that there's going to be a daily structural trend change for a higher low over the do or die zone. And instead, we did technically hit the lower edge of the weekly expected move. It wouldn't be unreasonable for a little bit of snapback that started to happen into the afternoon session here. However, what's now the new daily base case? Well, any of the rallies that offer a lower high rejection at the do or die zone, I think the sort of writing's on the wall where we could say, okay, there might be reasonable expectations for risk, reward back down to the equal low, and then ideally, if this is not a daily trend change, if this has completely failed, then ballooning runners underneath the low of today's session should start to bring in something like 494, the bottom end of this balance range from back here. I think it becomes a little bit more clear when we get to the hourly time frame chart, and something that I just immediately want to flag is one of the worst things that you could do, right, is just throw away all of the sound risk-reward principles that you normally trade with just because the base case has changed on the daily time frame, right? So what I mean by that is, are we just blindly fishing for shorts now here and getting short in the hole at the very bottom of the move? Probably not. If the market rallies and can set a lower high in this zone that we've identified already as being quite key, and if this gap remains unfilled basically from today's gap down, then the bears are probably in control. So any reversal signs up here around 520.50 are now just top of mind for, again, rally, set some sort of hourly lower highs, lower highs, some kind of lower high in this zone on the hourly time scale after producing a lower low from here to here, absolutely qualifies as hourly trend continuation. And once again, your risk and reward might look something along these lines to begin with, and then ballooning runners down here. Now, there are some arguments to say, like, okay, let's not get overly aggressive on the sell side, right? And one of these reasons, or one of these logic points, might just be that if this is now technically going to turn into a balance range, and this is probably more so from the daily time scale, you could make the argument that we have lows, we have higher lows, this is maybe a higher low, right? If we now just have equal lows across here and equal highs across the top, then this could technically be a balance range. Now, to me, I'd still be very open-minded to a potential short on a rally rejection of the 520.50, 523.75 area gap fill reversal to the Thursday low of last week. Very interested in the lower high here. However, if the market rallies above that, do we just immediately flip-flop back to the long side and say, okay, it's time to rock and roll, market's got to go to all-time highs? I would say we would want to wait and see if this can confirm some sort of inverted head and shoulders, in which case your long entry now is going to have to wait. It's going to have to wait and be patient over 531.75, right? Something along those lines maybe puts this back in play for the weekly test of the potential lower high here that we were talking about on Saturday, but that is not, right? We've acknowledged that the base case has changed here. This is no longer the base case. Upside is no longer the base case. The base case is we've failed the level, the market's failed the level. We are looking for a lower high on the back test. That would be a classic Brigade bolt to the downside. Risk reward that looks something along these lines, that plays, and then we can certainly look for this. Now, I was mentioning just a second ago, there might be some reasons to not be overly aggressive on the sell side, right? One of the logic points is that this is just a balance range, as we've just made note, calling for lows and now equal lows, highs equal highs. That's one argument. Another argument is that we technically looked underneath the low of this first major Thursday overshoot. And if you recall, this breakdown right over here was one of the reasons why we got bullish in the first place. It's because off to our left, we had single prints through the 90-day pause rally, right? And if we just actually go on over to, let's go to our good friend, the market profile, you can see this here out of the ES. These are your single prints over here on the left. If I do something that looks like this, notice that we technically looked underneath. The white on white is a little hard. Let's try blue. Cyan, if we want to be precise with our colors. There we go. So these are the single prints that remained. This is the Thursday low that blocked off the remainder. Notice that we looked underneath those single prints, or underneath, I should say, the low of this Thursday session, and yet, did the single prints close all the way on the downside? The answer is no, it did not. So is there still something interesting here to be said about the strength of the sellers? Now, maybe. Now, I'm certainly not going to sit here and say, oh, there weren't stronger sellers today. That was just a nothing burger. We already talked about the market internals, right? Big downside, weak index score, trend lower zone, big negative build out of the cumulative tick here. It was bearish at the exchange level, undoubtedly. There's no arguing with that. But to some degree, I do think it's worth acknowledging at the same time, right, that still the sellers were unable to close the single prints. Now, maybe that happens tomorrow, but for now, it might just be an indication to say, hey, anybody who's shorting this thing dead at the lows, probably not being mindful of trade location, risk-reward location. And I do think that if we were to see this snapback, some sort of counter-trend rally to retest this zone in here, then my first thought would be, okay, can we find some sort of backtest short for risk reward along these lines? So that's the new updated sort of base case as we walk forward from here. If you really want to go out on a limb and stretch this, you could say that this is sort of like a head and shoulders. This would be a neckline retest in here. And once again, Brigade bolt plays in the downward direction. We've seen the strength of the sellers at the tape, at the exchange level, and that, of course, is worth carrying forward as well. Did the other indices fare the same, is the next question that we might ask. And, of course, the answer is absolutely. If we look at the QQQ, we did see a failure of the base case bullish hold level. This was at 441 with a zone down to 438.25. We opened on a gap down underneath, just like in the S&P 500. The story is the exact same here. So that is bearish. Any rally attempts that fail on either a gap fill reversal into the Thursday low of last week or just any signs of weakness under 441 on rally attempts, I would be thinking about the opportunity for a lower high here to ultimately rotate back back down not only to the equal low of today's session, but then down towards the bottom of these lows, the origin, so to speak, of the 90-day pause rally. That's 414.50. So again, keep in mind that we don't just want to throw in the towel on the long side and immediately say, okay, it's time to short the market now. You still have to remember, right, risk-reward principles that would dictate where can I get involved, where do I have some sort of edge, where can I manage my risk? That becomes the key question out of all of this. On the hourly time scale for the QQQ, you can start to see how any rallies into this zone, you could manage risk just like the S&P 500, not a shocker here, something along these lines. Risk-reward for some kind of lower high rejection, gets interesting back down to the equal low, if not some sort of rotation here, the origin of the 90-day pause rally that we were just talking about, 414.50. Something we didn't talk about over on the spiders, and I'll show this on the QQQ in just a second as well, but I do want to be congruent here, is let's take a look at the intraday anchored VWAPs, right? A really important loss today of the anchored VWAP from the capitulation low gap down of the Monday session from now, 3 Mondays ago. That anchored VWAP from the gap down there has been lost. So once again, rally rejections of this zone certainly set up a reasonable expectation that longs, anybody who, quote, bought the dip from down over here, is now going to be underwater, right, on that lower high. And you can see the same thing here on the QQQ NASDAQ. As we take a look, the anchored VWAP cluster is right in here at the top end of that do or die, or really the midpoint of that do or die zone, 441, 438.25. Lower high rejections there are in play as the first thought. And again, if we are just going to get whipsawed all over the place, if this is going to turn into a nasty market, then something that looks like this could be a recovery effort, but just like the S&P 500, I would really have to wait and see some sort of acceptance over that 449 to start retargeting the equal highs up here, which would be closer to 465.85. So base case is this. Secondary back pocket would be something that looks like this, patience, and then really looking to interact on the Brigade bolt here. 449 becomes that key level. NASDAQ market internals really won't shock you. They are almost identical to the S&P with strong volume outflows happening here, in trend lower zone, and a 45-degree line out of the cumulative build on the tick. If we take a look at the market profile for the NASDAQ, what we can see over here, and perhaps we just read into this a little bit more on the NASDAQ than we did the S&P, here is your value area clearly disjointed. It is not overlapping to up. It is certainly lower, and the point of control also moved lower on today's gap down also. It's not like it was left higher in the session. We do have a little bit of a B-shaped profile, which could indicate long liquidation. The only thing that this starts to set up as an interesting idea would be if we could take out the B period highs around 18,000 in the NASDAQ, we might rotate through the A period single prints to do something like close the gap. And then once again up here, I would be thinking about that rejection back to the downside for our lower high we were just exploring on the hourly time scale, right? So this could be quick draw McGraw scalp for the upside. You could trade that single print retracement, but when we get here, the more structural traders will absolutely be thinking about a potential lower high on the gap fill reversal. Let's take a look at the Rusty Russell and just get a quick check as to what happened over here today in the Russell side of the market. So we knew that the Russell was weak in the first place, just noting that in this range, it never really broke out. It sort of was trying to get some semblance of price acceptance out of the midpoint, trying to get into this upper third, if you will. Obviously, that failed on today's session. The Russell was not immune, falling back down into the Armageddon zone, if you will, where there's not much that we're really interested in here. This is bearish to neutral for the broad market. If it's going to be bullish, you would really like to see price acceptance over 184.50, which, keep in mind, the Russell did not open on a gap down. There was no open underneath the Thursday low, never mind, not even close to the low of the Wednesday session over here as Powell was speaking. So there was much more of an opportunity for small caps to neutralize, and yet it just didn't happen. So that's another bearish data point that, of course, the sellers would want to carry forward. As we take a look at the hourly time scale, you could see a lot of the same indications that we were just talking about with the potential for a lower high here underneath the low from the 90-day tariff pause rally. That would be right here now at 184.50. Any lower highs in this region really kind of keep the market, at least the Russell side of the market, in this choppy zone where I don't really think that the buyers have an overwhelming edge. I would say it's neutral to bearish in this zone. Let's move on over to the Russell market internals perhaps and just quickly check in on what's happening here. And then we'll speed up through some supporting evidence and other indications. Notice that the Russell volume outflows were not substantial underneath negative 125 million. We were in trend lower zone here, and the cumulative tick did build with a 45-degree line into the close. That is substantial. Overall, the bears still have an edge out of the rut. If we take a look at the market profile for the Rusty Russell, you can see over here on the open, which was still inside the prior day's range, right, there was an opportunity for the market to try to build out just sideways value, not really progressing it in the downward direction. Lo and behold, what happened? Value was clean to the downside, right? No overlap with the Thursday session, previous day's session in the trade count right now. So with that, bears have the edge across the board. The gift was given straight back. The bullish base case is completely broken, and we know what we're looking for out of the S&P 500. If this is going to turn around, it's going to take some time. It's going to take building out some sort of structural inverted head and shoulders. But for now, I think that the bears have the new base case in their favor, looking for some kind of lower high now underneath these equal lows from back here. The do or die zone, as we've been describing in the S&P, that magic 523.75, 520.50. Let's quickly rip through the sectors and just see what's going on here. Healthcare, kind of a brutal day in the downward direction, rotating to the bottom end of its range here. This is either the third, I'm losing track of it. It's moving so fast. Either the third or the fourth heaviest weight sector in the S&P. So this breakdown is substantial actually for pressure to the downside here. As we move along to utilities, a pullback into the bottom end of the range. This is D for defensive, so not really concerned about that. Financials, I am concerned about as the second heaviest weight sector, unable to hold up over 46.40 with a nasty inside bar on Thursday of last week. Anyhow, we were trying to hold out here. We were trying to give financials the benefit of the doubt over the top end of the zone. Really, this do or die equivalent out of XLF. No dice on the close back down underneath today. This would have to immediately revert and do something that looks like this. And then the Brigade bolt over 47.60 probably gets us out of the woods if that's going to play nicely to the upside. Materials, really lightweight sector breaking down a little bit, but still holding a key area. Lightweight, let's just move along here in the sake of, in the interest of time, I should say, for a emergency meeting. Communications rotating more so to the midpoint of this range now just means that there's a stronger opportunity for a lower high should a counter trend rally persist. Instead of a breakout over an inside bar high could have saved the day. Now it's just a lower high threat. We'll take a look at industrials. This maybe has an opportunity to suggest a higher low holding here, but not a heavyweight risk-on sector. XLY is heavier weight and risk-on, of course. It's tit for tat with the XLV, third and fourth heavyweight. You can see here, just like the XLC, the lower low, of course, just means that even if there is a rally now, it is not just an inside bar breakout to save the day. It's an opportunity for a lower high. So move along to real estate. Not much to say about this. It's a lightweight sector. It is technically a little bit more defensive as well if you consider it a hard asset. So 39 here holding it's fine, but it's not going to move the market higher. XLE, sideways down here. Crude continues to get slashed, so really that global recession theme is stepping in quite a bit. XLPD for defensive going sideways up here, no gap down. This, if it breaks out and tries to carry the market higher, would be a risk-off rotation. We'll watch that closely. XLK, sayonara, just like the QQQ. It is hammer-esque in nature, long-ish lower wick with this little end-of-day rally that started to unfold, but like things we've been talking about so far, I think the base case would be if we reject this, it's just a lower high inside of where we didn't want to spend much time. If we do get above, okay, but can it maybe turn into one of these on the hourly time scale to then get back to the equal high? That's probably what it's going to take if there is going to be a stronger, more sound and structural reversal of this move. TLT bonds taking a little bit of a hit here today with rates moving slightly higher. A lot of tariff uncertainty still swirling around in the air of the market, so to speak. A lot of tension still with China vowing a global reciprocal tariff or reciprocal response, if you will. SMH looks horrible, right? And no gap close overhead, no nothing. Just any rally attempts that sustain a lower high underneath 195.15. It's a little bit more of a concern now for semiconductors. We were trying to, again, hold on to hope that, okay, these inside bars may have resolved to the upside here, closing the gap overhead and then trying to get outside of the do or die zone as we've been describing. And if you watched the bulk of the episode from the Saturday update video, you know that the sectors were where the threat really was to the base case. And of course, that threat seems to have played out. So that's semiconductors. If we look at some quick ratios here, we could do ratios and some supporting evidence. No love out of the ratio grid here for risk on, nothing risk on. XLV, it's D for defensive. Financials kind of hanging in there, but definitely not a risk on look. If we look at this, that is risk off. This is risk off outperforming. If we take a look at the risk on off specialized, you can see that this is not helping the bull case. This is not helping the bull case. This is not helping the bull case. This made a substantial new lower low. This is a little bit sideways out of ARC K, so we'll keep tabs on that. If we look at risk off B, what do we see over here? Gold continues to put in that blow off top, and maybe it's worth looking at gold here in just a moment. Bitcoin decoupling from the market as a, quote, risk asset a little bit here. A lot of chitter chatter online about that also. I'm still not sold on that idea that Bitcoin will decouple as a risk asset. So this is like, if you're bullish the market, you probably want to be looking at Bitcoin and say like, oh no, there's still like green shoots out there. It's just after everything we've looked at thus far today, I don't know necessarily that we want to put too much emphasis on the Bitcoin side of things. This indicating lower appetite for equity risk, more of a flight to safety, although both were down, obviously, right? TLT down less so than the S&P, seemingly such, suggesting that a flight to safety is still underway, and I think that all of the risk on-off charts we've looked at so far would echo that. As we look at metals, perhaps just to continue to peek at gold here, let's maximize the gold contract. Look at that thing, up and away. At some point, there will be a nasty pullback in gold. I'm not going to try to call for when that ultimately is. One of the things that has been driving gold higher, obviously, is just the fact that the dollar is getting absolutely bludgeoned here. A lot of US dollars for sale, and a lot of equity, or not even equity, but just a lot of money circulating back into domestic markets, right? If you look at something like, we've been using the 6E for the euro as just an example here, continuing to chip away in the upward direction. US dollars getting sold, euros, money flowing back home. Basically, it's sell US, right? Get out of the US and get away from the volatility and move back home where there might be a little bit more certainty and stability. So we'll see if that ultimately plays out, but that's the theme that's unfolding, at least as of right now. As we move into, let's jump into bonds. Let's not check in on the Fed tracker tool as of right now. We'll do that on Wednesday. It's a pretty slow moving tool, and there was no fundamental news this morning. This somewhat remains intact, and remember we talked about this and acknowledged the shift in timeframes here in the weekend update video. All this would continue to suggest is that the long end of the curve getting sold, driving rates higher, means that inflation concerns are being reignited, and that doesn't really take a rocket scientist to figure out. But then the shorter end of the curve is getting a little bit of love as people maybe, try to find cash equivalents that will give them at least some sort of yield, right? Which is why this is still in a downtrend up here. So that really doesn't bode well for risk on in equities down below, kind of tying into the breaking of the bull case, the bull base case that we've gone through so far in today's episode. Credit spreads did not expand to a new high, but they didn't make new lows. I think that that's a very important distinction here. One of the things that credit spreads will help us with is if this is going to settle down, you're just going to want to watch for new lows. Watch for new lows. That did not take place on today's session. As we move into junk bonds in isolation, they're still divergent in the upward direction, but recall that junk bonds, not in a big way, but they can outperform equities when it comes to the, air quotes, recessionary environment, right? And again, they're probably both moving in the downward direction, but junk bonds a little bit less so than the market itself. And you could probably use a different proxy like LQD instead and say something like corporate grade will probably move down in tandem, but less so than equities, the riskier of the assets down here. So that is junk and corporate grade. We talked about Bitcoin breadth, seeing a contraction out of the moving average charts, but really nothing overly concerning out of new highs versus lows. I would think that the logic, obviously, behind that, you're not going to see big new lows until we take out the capitulation low that we've been talking about in the S&P 500. Moving into something like the RSP, just to confirm that it was not just a handful of stocks pushing the market lower today, it was broad-based, and I think the internals dashboard confirmed that anyhow. If we move along to volatility, though, this is maybe where we put our thinking cap on and say something along the lines of, okay, why did we make this big substantial lower low, but yet volatility did not break out in the upward direction? If you're not a fan of the VIX, you could do, of course, something like the VVIX and say, okay, still no breakout here. Nothing going on from that perspective, right? If we take a look at the single day VIX, which is the 1 day down here, no breakout down here either. Notice that we're just contained in this range. We have not made the full risk on rotation. When and if we move from these elevated reads down to something like a 745, that becomes more of a signal to say, okay, we're in the clear now, but we still didn't break out. So once again, as I think we were talking about on the S&P 500 hourly timescale chart here, it's not worth, just like, okay, the bullish base case is broken and it's time to throw in the towel and just like short this thing into the ground. That's not what it's all about. It's about like being a little bit more reserved and less bullish about this causing a market reversal here and more open-minded to, okay, at minimum, this at least could provide that lower high as we've described, but it also wouldn't be insane if the market tries to do something that looks like this based on what we just talked about from a volatility perspective. If I go back here, if the market was preparing for another down leg, like sweep the low and, oh my goodness, it's new lows and we're going to be down 50% off the all-time high, then the 1 day VIX should be somewhere up here. right? And that's just not the case. That's just not what we're dealing with as of right now. A little bit deeper of a backwardation versus the backwardation we were dealing with into the close of last week, but still nowhere near the max fear of what we were dealing with on the capitulation lows from back down Monday of a couple weeks ago now at this point. Let's quickly get through the core list of companies. No additional trade ideas for you in the update today. We have not done the scan yet. Maybe we'll post some charts to X later on this evening. But for now, let's just rip through these. If we look at NVIDIA, you can clearly see a lot of the core list of companies were bearish as of Saturday's update. So if you made it to the core list on Saturday, none of this should really be shocking to you, right? Any rally rejections underneath 104.75, there's your reason why it's bearish, right? The market tried to recapture. There was no higher low above. This would have been the ideal case for the buyers. This is a nail in the coffin to that. So rally rejections for lower highs under 104.75, keep this thing moving in the downward direction. It could even be as simple as gap fill reversal underneath the two equal lows from Wednesday and Thursday of last week. If it is going to be bullish, you would have to show me some sort of acceptance there for lows, higher lows, higher lows. I'd be more interested in a possible gap close here. There's more range to trade for in the upward direction over 106.85, 110.25 is the close. As we look to Microsoft, again, bearish on the idea that we opened on a gap down underneath three equal lows after Microsoft was unable to hold on to 377.25. In a picture perfect world, once again, this would have been the ideal outcome for bulls. The fact that Wednesday and Thursday of last week broke beneath that level with acceptance, the writing, maybe the writing was on the wall. Maybe we were a little bit too optimistic in the Saturday update video, but for now, we ride on, right? Let's take a look at Apple and see what's happening from this perspective. Hammer on today's session, unable to close underneath the Wednesday low. I would say of all the counter trend players out there, Apple might be the one. It might be the one. Nothing crazy, not a second mortgage on the house, but a stronger rally into the close. Much more of an opportunity for acceptance over 192 to do something that looks like this for risk reward along these lines. I just like the range that's available. I also like the fact that technically speaking, this is a hold over the base case, a little overshoot, but it's a technical hold over the level here, right? This is the equivalent of the SPY 523.75, right? So the fact that we're holding that 192 Apple daily hammer candle, little dragonfly doji down here, that might be interesting for upside. So I'll watch that. I'll reserve Apple for a counter trend move. Amazon, ugly today. We were patiently rewarded for a lower high up against VWAP. Shout out to anybody who took that trade. And what do we have going forward here? Well, anything that remains underneath 171, gap fill reversal, lower highs, equal lows become the target, 162.25. Hard to turn into a bull over here. So we look at Google. What's going on with the Goog? Same concept, breakdown of the key level. This was neutral before much of the breakdown here on today's session, but now certainly bearish on a lower high underneath 150.50. If it is going to recapture something along these lines, maybe turns it into a reversal, but I'm not fond of that setup. I would not be fond of this higher low. Base case on Google, something along these lines, 144 the target, and then on the downside below that, probably 138.65. Metaverse bludgeoned today again. The Zuck selling something like almost nearly $1 billion worth of shares. Imagine the capital gains tax that he's going to incur on $1 billion sale. Insane. Regardless, big gap overhead that potentially could close. Any gap fill reversal, any lower high rejections underneath 505, it's bears. Bears in control. Where do we become bullish? Either on an extension and a new reversal pattern down here, something that looks like this into the future, or if it is going to rally and recover, something that looks like this can get you along from 505 into 529.85, but one step at a time. Bears are in control for now. As we look at Tesla earnings after the close tomorrow, so really not interested in trading Tesla tomorrow. Let the IV get all wacky, and then, of course, you can watch for trades to unfold into the back half of the week. But if we're just looking at the chart objectively, maybe let's start on the daily time frame. Balance range here, in theory, is nothing more than a bear flag, consolidating near the lows, breaking down from this range. I mean, if earnings weren't tomorrow, I would be more bearish on Tesla than I would be bullish, right? If we take a look at the hourly time scale, I would say something along the lines of if the hammer resolves for a gap fill reversal, reject the range overhead, 241 rejections, equal low breakdowns, lower lows. That would be sort of my base case out of Tesla, but earnings, anything goes, right? Let's take a look at JP Morgan. This honestly looks not bad relative to the XLF chart, which broke down underneath its key level. But JP Morgan here holding up over 228.75 on the pullback. If this is still going to be a bull flag, maybe the hammer high gets interesting out of financials to rotate back up towards the highs. So watching something like 233.65 at a JPM could be lucrative. If not for a trade in JPM, literally just to understand that you don't want to short the S&P 500 at the lowest low of the day if financials are breaking out and trying to produce a higher low on the daily time scale, right? So that's really why that has a place on the core listed companies. Netflix, what a day. What an interesting day. Interesting pop here in the morning session. Tried to pull back over 999 and just no follow through in the upward direction, of course, on a day where the market was just falling off of a cliff. So we'll let that continue to simmer out and settle into some new structure here. If anything, the daily inverted hammer, not really looking too great, and potential for shorts underneath that low into the 950.25, the big inflection point that marked the neckline of the big old head and shoulders here, and of course the inverted from down over here. 950.25 would be that idea. That's all I've got for you in today's emergency meeting. Once again, S&P 500 daily bullish base case has been shattered via the aggressive selling on today's session, which is being picked up at the exchange level through the market internals. I don't think it's worth fighting this. I think it's worth maybe being aware that a counter trend can get you to the gap close, but now the first thought should be some kind of lower high in here. If it rejects, equal lows and then lows down here. If it does do something that looks like this, that's fine, but it now has to do, it has an added burden of proof, right? The added burden of proof is such that we need this to turn into some sort of inverted head and shoulders and then get back up towards the equal high if, big asterisk and emphasis on the word if, it is going to just be a whipsaw and a big fake out and oh my God, he was bullish, then he was bearish, then he was bullish again, and this guy has no idea what's going on. No, we're taking this day by day. I don't think it's worth making a bold call. I think we were a little bold, calling for the higher low here, didn't persist, and now, right, we pay the toll of volatility. We look for a little bit of a lower high here. If it unfolds, great, we have short opportunities. If it doesn't, then we know what we need to do next. We know what we need to do next at 531.75. That's what I've got for you in the emergency meeting. If you enjoyed it, if we should do this whenever the market freaks out, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live again tomorrow morning at 8 o'clock Eastern time to, of course, bring you the pre-market prep. We'll build a game plan for the trading session ahead and, hopefully set ourselves up for success. Like today, we were not shocked. When the market opened on a gap down, there was no shock there, and we actually prepared for downside trades. We were looking for lower highs underneath VWAP intraday, right? So show up to that. Even if you don't enjoy these videos, you might enjoy that shorter term trade planning, and we're a little bit more nimble in those episodes. So truly going to leave you with that. Have a green trading week until Wednesday. I'll see you there for sure at the Wednesday midweek market update. And until next time, I will see you in the next one.